The frightening part about the U.S. economy right now is the rising loan delinquencies across all categories with consumers. I'm going to share a story I saw out of Seeking Alpha yesterday. And it's important that we understand, no matter what you see going on in the stock market with the equities and with, let's say, the top 10%, the reality of the economy that we have right now and the conditions is really bad. My intro for today's video was going to be, hey, don't pay attention to the rallying stock market today. Don't pay attention to the NVIDIA rally and what's going on over there, because 90% of people are struggling to stay afloat right now. And then I put on CNBC a couple hours ago and saw that what was a feverish rally this morning out of the gates turned totally upside down. The Dow ended up closing down 386. I think that was pretty much a 1,000-point swing. I believe this morning the Dow was up about 700 points, maybe even higher. NASDAQ fell 486 points. I believe that was about an 800-point swing. Don't quote me exactly, but I think I saw NASDAQ up this morning pretty substantially too, at least 500, I believe, up 450. Here's the important part. For the first time in several days seeing the pullbacks, the 10-year bond yield actually went down. I'm seeing it down almost 5 basis points, sitting at 4.08. So let's keep an eye on this. Once that 10-year falls below the 4%, it's going to signal more fear, more people moving into safe haven assets. I believe the VIX is also up substantially today. So is there some real fear coming to the markets? We'll have to wait and see. So before I jump into the story for today, as I always humbly ask, if you're not subscribed, please hit the subscribe button so we keep growing the community. I do appreciate all of you for being here and watching. I understand your time is valuable, and what you watch, you can't look at everything, right? So thank you again. So I saw, I think yesterday or the day before, and I did a little post about it, was that real wages in this country had gone negative. And so I pulled some information to share with you. That's kind of the backstop for what's going on. And that's why people are barely staying afloat, and you see delinquency rates rising. Their income is not keeping up with the pace of inflation and the expenses. Regardless of what you hear from Main Street, mainstream media, and all the talking heads. According to the Bureau of Labor Statistics, for August 2025, real average hourly earnings for all employees rose only 0.7% year over year, while the CPI rose 2.9%. That means that purchasing power is barely creeping up. Month to month in August, real average hourly earnings actually decreased by 0.1%. And a survey by Indeed suggests over 40% of U.S. workers say their real pay has declined in the last year. Okay, so the story of Seeking Alpha, it's entitled from yesterday, U.S. Economy, the Scary Part of Rising Loan Delinquencies. Sometimes it's good. I know it's not happy, pleasant, puffy white cloud, unicorns and rainbow news, but it's good to understand and have these statistics in your mind so that you don't get distracted. If you're in that bottom 90%, you're struggling, it's 1 foot forward as you go, okay, and keep trying to better your situation. If you're in the top 10%, do not discount the fact that the 90%, are an overwhelming majority and they're struggling. And a day like today, the stock market did not go up. We're starting to see the cracks start to form now. Will this be the beginning of a broader sell-off? I posted something earlier that Goldman Sachs came out, Reuters came out and said Goldman says they see a potential hedge fund sell-off of stocks of $40 billion in the coming week now. Who knows if that's going to be accurate or not? But nobody, I don't care if you're in the top 1% or the bottom 10%, no one's immune from what is happening. So this story this is pretty raw, but needs to be heard. We circle back, it says, on the health of the overall U.S. consumer. After all, nearly 70% of U.S. GDP is driven by consumer activity. The top 10% of households by income continue to hold up quite well, right, for now. They now account for roughly 50% of all consumer spending in the country. That's up substantially from 35% 2 generations ago. All right. And it says the cohort will likely, and here's the caveat, will likely continue to prosper as long as the stock and real estate markets don't crack noticeably and job growth stays positive. We know what's happening with job growth and the onslaught of AI. We're starting to see maybe some cracks in the stock market and real estate as well, okay? You can see the increasing angst and stress within the vast majority of the population, it says, by looking at rising loan delinquencies in just about every segment of finance. The weakness is starting to impact results from more consumer discretionary names that depend on the mass market, okay, like Home Depot, which fell 6% on Tuesday after reporting mixed Q3 results, all right, and offering soft forward guidance. Other names like Starbucks and Chipotle, among other well-known names, have posted tepid third quarter results as well. Target reported third quarter results Wednesday morning before the bell, and it showed that same store sales fell nearly 3% in the third quarter of 2024. I'll tell you this, my Starbucks, the one I go to fairly frequently, the drive-through lane it used to be out the driveway, okay, and around the building. Now, usually there's maybe one or two cars, if that, during peak, hours when people are going to work. All right, so let that kind of sink in. Consumer stress is starting to have increasingly dire outcomes. Chapter 7 bankruptcy filings have risen 15% through the first 9 months of this year compared to the same period of last year. In September, Chapter 7 bankruptcy filings were up 19% year over year. Student loans have started to be reported now again to the credit reporting bureaus. This has significantly reduced the credit scores for millions of Americans. And of course, that reduces their potential for buying, or the buying pool, right, for automobiles, homes, boats, RVs, appliances, all things, right? Speaking of auto loans, things are getting dire in the auto loan segment. United States is tracking 3 million auto repossessions in this year, 2025. That hasn't happened since 2009, right? During the peak of the great financial crisis. Fitch Ratings reported that in October, subprime auto loans that were 60 days or greater past due hit 6.65%. That is a record delinquency level. The concerning part of this story is usually the last two bills. Well, what they're saying is those are the last two things, right, that consumers don't pay. Their rent and their mortgage payment and their auto loan payment. This is an ominous sign around the health of the consumer. Credit card debt now stands at $1.2 trillion, an all-time record. Credit card loan delinquency and charge-off rates are far lower than during the great financial crisis, it says. However, they are surging now and significantly above pre-pandemic levels and continuing to rise. Finally, increasing consumer stress. Did a video on this yesterday. Increasing consumer stress is a huge factor behind the explosive growth in the buy now, pay later. A financing option that first appeared in 2019 is now utilized by 1 in 5 Americans. Take a look at yesterday's show on the infusion of capital into Klarna and what they're doing. The average buy now, pay later balance is now just under $2,100. This should be raising red flags as it isn't exactly a picture of consumer health, right? When it says a good slice, well, this is a tongue-in-cheek, of the consumer population is financing the purchase of a pizza. 10% of consumers, we got to be careful with that group too, right? Because they're dependent upon their wealth, their stock portfolios, things of that nature continue to go up, right? And they're keeping consumer spending going for now. I've done some shows recently about the fact that they're also pulling back. You're seeing a lot of those in the top 10% shopping at Target now, right? Not Nordstrom. The scary part of fast rising loan delinquencies is that it's happening despite, it says, nearly 4% GDP growth over the last 2 quarters. And when job growth, it says, still remains positive despite slowing significantly from the first half of the year. And it asks rhetorically, what happens when job growth goes negative and GDP growth falls substantially? And he says investors won't like the answer to that question, meaning the top 10%. So once that starts to crumble, look out. But 90% right now are really just trying to keep their head above water. So no matter where you're at in the spectrum, please try to keep that in mind, especially going into the holiday season. Maybe you can help somebody out. If you're fortunate, help somebody else out that's struggling right now with the lack of a job or with a health issue or whatever it is. So leave it there today. We don't want to go too long. Not a pleasant set of not a pleasant data set, but it's reality, folks, of what's happening. All right. With that being said, as I always say, if you enjoy the content, leave me a like, subscribe to the channel if you're not subscribed, leave your thoughts and comments. With that being said, I will talk to all of you soon.